And so I believe a significant illiquidity process is emerging. And it will only become more evident as time passes. And I think that is a deflationary event. And
All right.
I think the Federal Reserve is behind the eight ball, well, way behind the eight ball.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. It's an especially confusing time for investors given how divided the experts are on whether resurging inflation or disinflation deflation is more likely from here. Your answer to this question determines whether you think the Federal Reserve starting to cut interest rates is a good idea or not. Today's guest has very strong views on this matter based on a lifetime of study. For perspective, we've got the great fortune to sit down with one of the greatest living economists, Lacy Hunt, former senior economist for the Federal Reserve Bank of Dallas and current executive vice president of Hoisington Investment Management Company. Lacy, thanks so much for joining us today.
Glad to be here. Nice to see you, Adam.
Always wonderful to see you, Lacy. Thanks so much for joining us. I know I stand between you and your Labor Day weekend, so we'll wrap this up as quickly as we can. And first and foremost, I just want to let folks know we're going to talk about your thoughts on current Fed policy here, Lacy, but this really is just the appetizer, even just the amuse-bouche, if you will, to your appearance coming up at the Thoughtful Money online fall conference, where you give really a graduate level walkthrough on where you see things headed from the macro perspective. You walk through a ton of charts that you create specifically for that event. So, I'm not going to dig too deep with you on these issues because we're going to get a chance to do that in real depth at the conference. That being said, let's get started
I
here.
might go deep, however.
You do whatever you want, Lacy. You always have carte blanche to do whatever you want. So let's kick it off here. What is your current interpretation of the status of fiscal policy today?
In one word, it's extremely restrictive. And I know that that's not the general view, but let's just look at some of the facts here. So, according to the Congressional Budget Office, the Big Beautiful Bill Act will add $3.4 trillion over the next 10 years. That's 340 billion per year. However, embedded in that number are roughly $3 trillion of let's call them accounting tax cuts. Accounting as in terms of stipulated by the law and the procedures of the Congressional Budget Office. And in addition, there are $3 trillion worth of expenditure reductions. So the net increase in federal stimulus measured in this very narrow sense for the 10-year period is $400 billion or 40 billion per year. However, that is while all factual, not very useful. Now, the S&P Global, who recently reaffirmed the credit standing of the United States, said that the fiscal situation is stable, that it's neither improving nor deteriorating, in spite of the calculations of the CBO. And the reason that they said that is that it looks like a reasonable assumption is that over the next 10 years, tariffs are going to add $3 trillion in revenue or $300 billion per year. And so if you have a net 3.4 stimulus and you have 3 trillion in tariff revenues, you're almost in balance, more or less. One
Hmm.
washes each other. Um, but that is a simple mathematical calculation that is not the dynamics of the economics. And the reason is that of this 3.4 trillion in stimulus in the big beautiful bill act, is that $3 trillion was a mere rolling over of the 2017 tax cuts.
Right.
The tax rates that are in effect this year and went into effect 8 years ago are the same tax rates that will be in effect in 2026 and for the 9 years afterward. So there's no net benefit in any sort of macroeconomic sense from extending the tax cuts.
Hmm.
So the way I look at it is that there is roughly $3 trillion of expenditure reductions plus the restrictive effect of $3 trillion over 10 years in tax revenues. Now, and that's why the S&P Global can say that they're in balance. But the matter of fact is that even there, the calculation is too simplistic because there are many dynamic effects that are going to take place as a result of the tariff increases. And this is what I want to talk about.
All right.
The main feeling is that the tariffs are being absorbed and there hasn't been any significant damage yet. But I would not share that view. The way the tariffs work out historically, it's a very, very slow process. It goes through multiple stages. Um, the first act of raising tariffs is not the final act when there is retaliation. And if the parties that the instigator country and the retaliator country are not happy, you may have second, third, and fourth round of tariff increases in retaliation. And we're seeing
Yeah.
that.
The whole tit for tat. Yep.
The whole tit for tat game goes on. Now, so the other thing that we have to take into consideration when we're talking about tariffs is the nature of the goods that are in the international flow. And the bulk of them, with the exception of certain energy products like gasoline and life-saving drugs and maybe some life-saving medical equipment and perhaps a few rare earth minerals. The All of the rest of the goods are highly price elastic.
Hmm.
In other words, if you raise the price, you get a much larger percentage decline in demand than you would for the average product that would be traded uh, on a global basis. And
Right. Because
so
people can either forego it or they can choose substitutes. Yeah.
they can. Well said. Time is very important. Time can be a substitute. Um, and you can also shift to older equipment, for example,
Hmm.
or you can rearrange the production process, or maybe you can find a way to simply modify and amend what you're working with. And so the whole process is we're dealing with price elastic goods, and I personally would say that for most internationally traded goods, excluding the ones I mentioned, the price elasticity is 3, which means that a 1 percentage point increase in price reduces demand by 3%. So let's think about this in another way. Last year, the imports of goods were 3.3 trillion. And right now, it looks like here in August that the tariff rates in already in place are somewhere around 10%. So without allowing for the dynamic effects, 10% times 3.3 trillion is more than 300 billion per year.
Yep.
3 trillion over 10 years. That's why S&P can say the fiscal situation is in stability. However, um, when a country with dealing with price elastic goods, if they institute tariffs, there's retaliation because of the flatness of the curve. What happens is that prices go up initially, quantity demanded falls. If you use the micro model, the retaliation occurs, quantity demanded falls further, and the price level falls back. Now, the Fed Chairman Powell has only talked about the first round effect. And the first round effect can go on for months. But there is a second round, and because of this highly price elastic curve, the first effect, which starts slowly and then builds, is that there is a very significant margin squeeze because firms cannot push the price increase through rapidly.
Yep.
They would lose market share substantially, and people have options as to deferring demand or moving to other products or simply not buying at all. And so this margin squeeze, as it slowly materializes, causes a downward, or what I would call an endogenous shock to liquidity. And most of us assume that the Federal Reserve controls liquidity. Liquidity is an exogenous element. But no, this is one of those times, as demonstrated by the period from 1925 to 1939, that the imposition of tariffs can have several rounds of a negative liquidity effect. Economists like to use the term endogenous. So the first occurs when corporations experience the loss in liquidity because they sell less or have to take lower price or combination of both. But to get their house back in order, firms have to cut the demand for the factors of production, which would be labor, natural resources, and capital.
Mm-hmm.
And when they do that, then that causes another downward shock to liquidity. And of course, if the process is playing tit for tat along the way, the whole element is going on and on. But there's still another effect, which no one is talking about at all. Is the objective here is to raise tariffs and to improve the trade sector. However, the trade sector is the inverse of the capital account. And capital account is the same thing as net foreign saving. And so if you improve the trade deficit, you worsen the capital account. Now, the capital account is in the saving of the foreigners that have by necessity plowed back into the United States because they want to sell us more goods than they want to buy from us, has resulted in the fact that the foreign sector owns 18 trillion of common stocks, of equities. They own 5 trillion of corporate bonds. I'm doing in round numbers here. They have 2 trillion of government mortgage paper, and they have 8 trillion of US treasuries. So when you improve the current account, the capital account is going to deteriorate. and there are going to be less funds for all of these uses that the foreign sector has been supplied. Because what has been the role in the past is we get goods and they get IOUs in the form of ownership of U.S. firms and directly through equities, indirectly through bonds, and by investing in other types of fixed income instruments in the U.S. And when the capital accounts begin to flow, that results in another downward exogenous shock to liquidity. Now, I'm not the one that thought of this. I wish I had. The whole process was originally described by the great Charles Kindleberger in his famous book, The World in Depression, 1929 to 1939. Now, Kindleberger is well known for his book, Manias, Panics, and Crashes.
Mm-hmm.
But he wrote about 20 different books in economics, including the one on the Great Depression. He also wrote the leading text, graduate text in international economics. It's now in its fifth or sixth edition. The World in Depression is probably in its fifth or sixth edition. I don't know exactly which one. But these endogenous shocks to liquidity create what Kindleberger, the process that he described, has been described by others as the Kindleberger spiral. So the tariffs, as they go on, reduce liquidity. Now, in the period there of the 20s and the 30s, the Bank of England had always in the past acted as the world's central bank. But they couldn't do that because they had basically been emaciated by World War I. The US was actually in position to take over and be the world's central bank, but they didn't want to take that role. And so as world liquidity was collapsing, the central banks were sitting on their hands and allowed this downward spiral of liquidity to occur. And so we've seen action by the EU, we've seen actions by the Bank of England, but the central bank of the world, because the US is the world's reserve currency, is still the one that counts. And so I believe a significant illiquidity process is emerging. And it will only become more evident as time passes. And I think that is a deflationary event. And
All right.
I think the Federal Reserve is behind the eight ball, well, way behind the eight ball.
Okay, and just getting to the punchline real quick, and I'll let you expound on it in a moment. But when you say the Fed is really behind the eight ball, presumably then not only do you think they should be cutting, you think they should be cutting by a lot more than perhaps just 25 basis points.
No, I think it's going to take a lot. I said, I was with you earlier. I said I thought they needed to cut by 100 basis points this year. And I think they still need to do that. They should have done it before now, in my opinion. And by the way, I said that before the president did. I don't want anyone to think I'm shilling for President Trump, but I believe that the case is there. That this process is very potentially very tenuous, and there needs to be significant central bank action here to offset what is going on globally.
Okay, and just to help folks appreciate the situation, let's say this was you're a fireman here and you're trying to rate the fire, right? Is this a one alarm fire or a five alarm fire at this point in time in terms of the urgency of the action needed?
I would say it's already a second or third alarm, but it's not putting off any smoke yet.
Mm-hmm.
And central banks like to say they're data dependent, but data is always backward looking.
Right. That's why they always criticize it for being too late. Yeah.
But you see, but this is a unique situation. The only other time that this ever happened was between 1929 and 1930. By the way, um, Kindleberger was of the view that the whole period was one of depression. And the only thing that ended it then was when the German tanks moved into
Yep.
Poland in 1939, which ended the process. And this has many um, similarities to me,
Okay. Well,
very many similarities.
let's hope the similarities don't evolve to being that similar. I don't think anybody would love to see another world war come from here, though I understand that, maybe that's a risk that's on the table. But back to my sort of question about what sort of severity are you ringing this bell with right now? Uh, if we don't act or we take the wrong actions here, Lacy, like how worried are you about what the outcome would
Well,
be?
if it, let me just say this: if it
Because
remains,
deflation isn't fatal. We have recessions from time to
we
time.
do,
I don't
we
get the
do.
sense you're worried about a garden variety recession, though.
No, I think it. I think that it is potentially serious enough. An ultimate outcome is deflationary, and um, the matter is very complicated. The tariffs are under constitutional review. They could be declared unconstitutional. I don't know what the outcome will be, but there are other issues that are at play. But I think that it's a sufficient risk that the Federal Reserve in the current situation should ignore the current statistics and look to prevent um, the negative aspects of a international tariff war of damaging the global economy.
Okay.
They should be moving in it well in advance of the process.
So let me ask you this then, Lacy. I mean, as I said in the intro, you're one of the most accomplished economists alive.
I don't know about that.
And I don't say that just to flatter you, but if I can flatter you, I will. But no, I mean, you've had a phenomenal career. Um, but I mean, the Fed has hundreds of PhDs working for it. Some of them have got to have read Kindleberger. Uh, up until this past Friday at Jackson Hole, um, Powell was pretty sanguine this year. Like, how
He
come nobody
continued to call the
there?
labor market strong.
Right. So I mean, so how come nobody at the Federal Reserve has done what you've done, which is just looked at the historical record and said, "Hey, look, Kindleberger respected. He wrote a whole book on this.
Mhm.
It's even called the Kindleberg spiral. Like, are they just ignoring it? Are they?
I don't know what they're doing. I don't know how their research is being formulated. I know that one of the things that I don't like about the Federal Reserve that we have the Federal Reserve has the most costly economic research organization in the world. But one of the things that I think that all of us is in the United States, regardless of our political opinions, the virtually all of the economists in the Federal Reserve are neo-Keynesians.
Mhm.
And um, there's an alternative view. It's a neoclassical view. I sort of fall into that camp. There's the Austrian view. There's the monetary view, which is a sort of a branch of the neoclassical school. These viewpoints are hardly represented at all. And it seems to me that the Federal Reserve has just settled into this notion that they will be totally data dependent and they will ignore everything else. And uh, but in some cases, I get the sense that the Federal Reserve, if they follow certain indicators and they don't like what those indicators say, then they flip. Um, for example, last year, um, uh, Chairman Powell at one point in time was willing to acknowledge that the quarterly census of employment and wages, the
Mhm.
QCEW, was coming in significantly weaker, or that the monthly payroll number was consistently overshooting. And we know from the QCEW that covered the fourth quarter of last year, there was a massive overshoot in the QCEW. I mean, in the payroll vis-a-vis the QCEW. But the chairman has continued to refer to the labor markets as being strong. And at some point in time in the past, the chairman has acknowledged when there were discrepancies between the household survey and the payroll survey. Well, since January, the household employment is down 600,000. The payroll is up 7. That's a discrepancy of 1.3 million.
Mm-hmm.
There's a lot of reasons that in fact the Federal Reserve is not as data dependent as they appear, and that they appear to seize on the variables that suits whatever their opinion about what they should do, not in fact a reflection of the way things are or the way things will be. I must tell you that I am very unhappy um, with the leadership of the Federal Reserve,
Which is
and
undergoing a lot of
this is on theoretical grounds and not political grounds at all.
yeah. Although I do want to ask you about that in just a moment because there's a lot of drama going on at the leadership of the Fed right now. But let me ask you another question that I just asked the other day. You said it's like the, most expensive research institution in government or whatever.
Macroeconomic research, he said.
Okay. So, and they look at data that appears to be obviously flawed or at least obviously imperfect in its collection, right? So we can see some of the issues with its surveys, right? We've seen tremendous fall off in, I can't remember if it's the household or the establishment survey in terms of response rates.
Households down sharply this year.
Yeah.
And
And these are these are sampling uh, surveys, right, where they get a small but hopefully statistically significant sample and then extrapolate a lot off of that. And everyone's heard about the birth death adjustments that they do to the models. In 2025, in the digital world, we have the ability to get extremely granular in our tracking. We have data sources out there, tax receipts, like actual, payroll data of who got paid what down to the penny. We now have the blockchain technology and theoretically, which can, kind of atomize all the data that's out there. And the Fed, just went through what, a 2.5, or they're in the process of going through a $2.5 billion renovation of their physical facilities there in DC. It seems to me that with a real small fraction of that, they could build dramatically better data collection systems and have much truer data and probably much more close to real-time data. But I don't see a lot of that underway. Do you have an opinion on that?
I can actually prove what you said is right. For example, the firm ADP, as they actually have a sample of about 22 million employed people, and they are able to take the QCEW data and benchmark the ADP series to every time the QCW comes out.
Mm-hmm.
I don't see the difficulty in transferring a computer file from point A to point B. Not today. And so if ADP can do it with their resources, why are we not able to do that?
Is there a valid? I mean,
It's very valid.
You've worked
I
for the
think
Fed
something
before.
is seriously
But
wrong.
is there a valid reason not to be doing this, or is
No,
it just
there's absolutely none what I know, none whatsoever. Um, uh, for example, um, we could view we could we could survey um, the top 20 payroll data processing firms in the country,
Mhm.
calculate a sample from them to do the surveying of the small and intermediate sized firms that are not captured by the 360,000 launch firms. I mean, the fact of the matter is they've just been absolutely stationary. And I think that one of the reasons the household survey is working better is that they have a pretty good sample. They're surveying close to 60,000 folks. Um, the last presidential election, there were pollsters that got the results right with a random sample of 1,800. You know, if you have a true random sample, it doesn't matter how large this universe is, the results will be excellent. I mean,
Right.
this is a process that should be much further along. And um, you know, you and I have had discussions about this in the past, and I don't. I personally think that it's bureaucratic failure. I don't believe that it's political. I just think that the Bureau of Labor Statistics is to data collection what the post office is to mail delivery.
Okay.
That's
It's more sort of just bureaucratic
I,
sclerosis,
yeah, I'm afraid so. Misuse of resources.
which
And
is so depressing.
well, you made the point about the Federal Reserve building, $2.5 billion. We're doing that, and we don't have good data.
Well, it's
How
just
can
crazy. Yeah. I mean, why would you even think about doing that uh, until you got your data house in order? If at the end of the day your institution exists to make good decisions, it doesn't really matter how much marble you have around the people doing the work.
no?
Yeah. Okay. Well, that's depressing. Seems like for some reason the Federal Reserve got inspired by Lady Justice and said, "Oh, we should just wear blindfolds here." Okay, well, look, you're tunneling over to the leadership of the Fed. So obviously, we don't have a great opinion of the Fed in terms of its data management and collection practices. Um, but and
Nor
you
the
and you
Bureau of Economic Analysis or the BLS. I mean,
yes,
it's just
yeah.
all falling short.
Um,
And you know, I mean, we have this big employment report coming up next Friday. The series is so flawed in the way it's constructed that um, the real tragedy for the economy would be that they continue to get it wrong and they have another massive overshoot of what is the actual truth. Um, Historically, one of the great uh, indicators has been this labor differential as part of the conference board survey. And you know it's fallen for 8 consecutive months, 8 consecutive months, and it's back where it was in 2021,
mhm.
early 2021, and this is massive divergence that developed last year, the year before that. It's continuing. Um, the differential deteriorated again in August after deterioration in 7 prior months. Um, but you know, if the procedure is flawed, it's flawed. And so when the number comes out, of course, the markets will react to it.
Mhm.
But it doesn't mean that the number is any more valid when the August number comes out than when the July number came or the June number came.
Well, so let me ask you this then, Lacy. So we've 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 got, if I understand you correctly, you think we are kind of hurtling towards a Kindleberger spiral here. but we're kind of blind to it, right?
Right.
I mean, in your mind, hopefully the Fed does start cutting because obviously every delay in cutting just makes what's coming worse. But obviously, until they really get religion around this, they're going to be behind the curve, right? And probably at some point realize that and then start panic cutting, which is sort of what the historical pattern has always been for them. Um,
Could I just say one thing?
yeah.
With you. Um, One of the problems is that the president and the chairman of the Federal Reserve are do not see the way the world politically the same way.
Hmm.
Clearly difference of view. Um, and we've seen this in the past, but the in the final analysis, monetary policy must reflect the true situation of the economy.
Yeah.
And if they don't, then the country is going to be very badly served by that. And so we're in a very, very difficult situation. Um, the the current administration uh, is doesn't like the Fed. Some of that is for political reasons, but what I'm more focused upon are these critical functional areas where there has been misstep after misstep, not just in terms of the last year or 2 years, but for a very, very long period of time.
So let me ask you a question about this then. And I know that there's a lot of discussion right now about, the potential um, political nature of the Trump Powell war, and of course, people like Lisa Cook, now involved in it, voting Fed governor. Um, but there has also been discussion amidst all this, especially from folks like Treasury Secretary Scott Bessent, of saying, hey, it's time to kind of just reevaluate how the Fed works, right? Do you do you have any thoughts, optimistic, pessimistic, or whatever, about this kind of, I don't know if it's a trial balloon or what, that's being raised at this time of like, yeah, we're going to replace, Powell when his term ends next year, but maybe actually say, hey, we're gonna ask ourselves, like, should the Fed operate differently? Is that a healthy thing to raise, and is this the right time to be raising it?
Yes, it should definitely be raised. The problem is that it is such a politically wired issue. I have seen no path to go, no way to take that path out.
Hmm.
Just too contentious, and that's sad for the country.
Okay. So kind of like the data collection, then you just don't think it's going to happen. Reform isn't going to happen on a pace that we're going to be happy with.
No, no.
Okay. All right. Well, let me get back to the question I was in the process of asking, which is, so you see, um, a deflationary period ahead, and right now we have sort of the wrong policy for it. Um, in terms of the important things for the people watching this video, like the employment market, um, what do you see lying ahead, especially if the Fed is too late to this party in terms of its response function? Is this
Well,
going to,
I
is
think
this a recession? Is this going to be one where folks are going to be worried about losing their jobs? Are we going to see job shedding eventually?
well, I think that there, if you Piper Sandler um, took the QCW report, which is not seasonally adjusted, and they've seasonally adjusted the QCW all the way back. And by the way, if Piper Sandler can do it, then why cannot the BLS do it?
Right.
And if the BLS wants to tweak the X11 formula that is the normal one used for seasonal adjustments, so be it. But the Piper Sandler seasonally adjusted series shows a sequential decline in the payroll in the fourth quarter from the third to the fourth. Not
Hmm.
big, but that's against a very significant increase. Um, one of the things that my good friend and yours as well, Danielle DiMartino Booth,
Hmm.
really first-rate economist, longtime friend of mine. Um, what she did is she took the payroll, the state payroll data, which is calculated entirely different from the payroll data in the monthly situation report. And she did it for the June, which is the last month that we have available. And uh, based on the state data, the sum of the state data, payroll data declined in June. Well, one of the things that the BLS should investigate is to see whether they could use the state data. It's coming out a little bit slower, but it's available for June. It's a hard count, and it doesn't rely on the birth death model.
Oh. So Lacy, I interviewed Danielle probably about 4 or 5 days ago. And yeah, she shared exactly that. And I think the number for June was a negative job loss of 65,000
Mhm.
with that state data.
Yeah. It's a credible piece of information. And I believe the QCAW, the seasonally adjusted by Piper Sandler, is another critical piece of data. And the fact of the matter is, um, we won't know for sure because we want to compare the QCW after the Labor Department has seasonally adjusted it to the seasonally adjusted payroll numbers that we have at hand. But if there is no material new information, we're going to have something like a Six Sigma era between the payroll and the QCW in the fourth quarter.
Wow.
Now, we had during the '07 periods, '07, '08, '09 period, we had an 8 sigma era, which the BLS took a lot of heat for.
Hmm.
And so what they did is they revised the birth death model, but they didn't kill the birth death model and go to a different approach. When they did that, the BLS said, we solved the problem. And right now, we're supposed to be getting an error of plus or minus 0.1%. But we have a similar size error as we did apparently during the time period of the great financial crisis. They didn't solve the problem. That's the bottom line.
That's the bottom line. So, obviously, when you run an economy using flawed data, it's not that dissimilar to a pilot flying a plane with erroneous instrumentation, right? Very bad things can happen with bad data. So in your case here, you think we're flying into, and you haven't used this word, but I'm going to use it and let you correct me if you disagree. We seem to be flying into a recession, um, not realizing that we're doing that.
I feel that we are, based on what I see, we grew at a 1.4% annual rate in the first half. To me, it looks like that if you exclude the AI, which is hard to do, and you get into a debate as to what you exclude, it appears that all of the gain in GDP in the first half, the 1.4, was due to the AI. Maybe, and without it, you might have had an actual decline.
Mhm.
It's close enough to, it was either a wash or a negative. And so we're here in the third quarter. It looks like the economy is just creeping along. the two numbers that I kind of trust, maybe three. This is based on July preliminary information. Real personal consumption expenditures in July are at a 1.3% annual rate above the second quarter.
Okay.
But the trade deficit is subtracting like 0.4 or 0.5%. And government spending, US federal government spending appears to be down. I don't have any additional information. That tells me that based on those numbers, that the US economy is positive, but not by very much.
Mm-hmm.
And if you rearrange the components a little bit and just rely on hardcore things like domestic final sales, that's also only growing around a 0.5 or 0.6% annually. Not very much growth.
Not
And
very much growth, right? Not very much growth. So this is where I think the difference between averages and median is important. Um, that growth, which is an average of the activity across the economy, to your point, is largely being driven by the AI sector, right?
it
So
is, it is.
yeah, so it's a small sector that's doing a lot of the work, right? Now, so
If you go ahead, Adam.
I guess my point is if you remove that part, if we're only kind of growing kind of anemically because the AI sector is keeping us positive, if you look at the rest of the economy, it therefore must be, growing very poorly or in contraction because despite the AI numbers, we're still only, only kind of muddling along. And where I'm going with this is it's that rest of the economy, which is where all the jobs are, right? The AI part of the economy doesn't have a ton of jobs in it. So I'm concerned about if we go through this Kindleberger spiral where you talk about, tariffs causing the margin squeeze, demand goes down, and companies that are caught between rising costs and having to cut costs because of reduced demand, we're gonna see a bunch of labor shedding in that long tail of the part of the economy that's not doing very well right now. And who knows? Maybe we avoid going into recession on average, but to many, many people, it may feel like a recession because personally, they've lost their jobs.
Mhm. Well, Adam, your point is very well taken. Um, do you have you ever interviewed Peter Bookwire?
Yes.
Very astute analyst, really digs into the data in detail. Peter calculated that if you look at the core capital goods shipments and orders, um, that the number we had a pretty good rise, from June to July, and you look at the first the first 7 months of the year, Peter believes that um, excluding the AI categories, that there was a net decline in everything else.
Yeah.
And it requires a lot of effort to do the calculation, and I have a lot of confidence in Peter. But another good friend of mine, David Rosenberg,
Hmm.
who has really outstanding team and staff, uh, I asked David whether Peter's calculation was correct, and he had one of his top flight economists and statisticians run the numbers, and it was very complicated because you're dealing with 12 different NAIC codes, but they confirmed that Peter's calculation was correct. And it doesn't matter whether you look at core orders or core shipments. Um, Once you exclude the NA, you're negative. In other words, the AI is booming and everything else is collapsing.
Is collapsing.
That's the
Okay.
basic picture, and that indicates that everybody says capex is doing well. This is an early sign that the immediate expensing that's part of the big beautiful bill.
Yep.
Is it work? No, I think it's strictly AI driven, and I don't believe that the immediate expensing works in an environment when the capacity use rates in the manufacturing economy is declining, and we're seeing an overall decline, which means that excluding AI, it's dropping pretty significantly. I think the pressure is already there. People typically, when you begin to deteriorate, you try to hold on, hopefully that it's a temporary event. But in this particular case, I don't believe that it's temporary.
It's temporary. Okay. All right. Well, look, Lacy, there's a bunch of key questions that, everything we've talked about tee up here. Um, how how bad could this get? How prolonged could it be? What do we expect to happen to interest rates and bond yields, which are an area of expertise of yours? What will be the knock-on effects in the financial markets? How might this impact treasuries, which obviously, that's what your firm Hoisington specializes in. We are going to get into all of that and more when you appear at the Thoughtful Money Fall Online Conference coming up in just, it's coming up fast, just what, a little over a month from now, month and a half. And then also, you will be joining us live after the official presentation and fielding live Q&A from the audience. So folks watching, if you have unresolved questions here, you'll be able
It's
to
one
ask
of
them
my
to.
favorite things to do. You have such a great audience,
Thank
and
you. It is
they
it's
really,
such a joy to watch. The smart people in the audience get to ask questions of one of the smartest economists out there, and you're so generous in your time and in sharing your expertise, Lacy. So it's such a pleasure to watch.
well, thank you. I have to be really on the top of my game because it's like a batter who's getting uh, fast curveballs coming in on the inside corner.
Well, you've been batting 1,000 so far in your previous appearances at this, Lacy. So as we start to wrap up here, knowing that we're going to get into all that stuff, is there anything else that's really kind of weighing on your mind or burning brightly on your radar right now that we haven't talked about that's worth mentioning here?
Well, one of the things that we don't know is whether what the courts are going to say about the constitutionality
Of
uh,
tariffs?
on the tariffs. We don't
Yeah.
know that. Uh, I personally think the administration had full authority under the 62 Act to raise the tariffs at least 15%. And their sector tariffs were, I think there's legislation that supports them. But I'm not a legal expert. I don't know, but I would have people to be aware of that. Um, uh, I just really don't know what they would do. It's a incredibly a difficult issue. Um, but assuming that we go forward with the tariffs, um, there is going to have to be a great deal of monetary support in the form of lower interest rates. Um, and I think that will reverberate across the curve.
Okay. I've got a lot of questions for you about that, but I'm going to hold off on them for the conference. Last question for you, Lacy, just before I begin the wrap up. Um, what are you optimistic about right now? We've talked a lot about it, pretty heavy things. Is there anything on the macro stage or even just life in general that you've got some optimism around?
Well, let me just, I'm not very optimistic right now. And one of the things that it's gnawing away at me, and this also goes back to Kendallberger and manias, panics, and crashes. And Kendallberger said that in manias, what happens is that you see valuations go to extreme levels.
Hmm.
Sometimes they're record, sometimes they're not record.
Yeah.
And if
Which,
the
sorry to
plane,
interject, but right now we can say check.
well, I'm going to run down them for you here. Just
Okay.
to answer. This is a great question. And also, there are significant risks that people dismiss because everything's so good and looks
Hmm.
so good. Let's look at certain valuations. Um, Burt Malkiel wrote a piece in the New York Times just in the last 2 weeks. Burt, who had the pleasure of knowing, wrote a great book, A Random Walk Down Wall Street, teaches at Princeton. His work led to the creation of the index funds, knows the stock market very well. He said that the price earnings ratios are amongst the highest in the last 230-year history. Um, uh, Another really astute money manager and this recognized thinker, Howard Marks. I don't know if you know that name.
I do. He's a phenomenal capital manager, very bright
Yeah.
man.
He calls the price earnings ratios a tent pole. And he cites work that looking at the forward PE ratios, they don't go back as far, only to the mid 80s. But the last time they were at these levels, um, the return on the S&P for the next 10 years was confined to a range of plus or minus 2%.
Hmm.
Howard also reminds us of where where Buffett's favorite measure is, which is the market capitalization to GDP. That's at an all-time high. And you know, another thing that typically happens in manias is that you get extreme financialization,
Hmm.
and people begin to use new instruments that presumably protect you from any risk. Well,
Like
I'm not an
the
expert.
portfolio insurance of the late 90s, right?
Yes, and other forms of financial. I mean, there was very creative stuff being done, new stuff, and the refinancing of the railroad boom in the 1870s, and they kept the thing running for a while. But ultimately, the truth prevailed, and even in the time of John Law and the Mississippi and Louisiana bubbles, there was financialization. Well, one of the things now is this use of private equity capital. Um, my good friend Jim Grant has been talking about it. Um, the default rates have risen a great deal in the past year. In addition, a lot of the firms no longer paying interest. They're um, doing these so-called PIK extensions,
Hmm.
paying in kind. The vault rate, according to the latest calculations I've seen from the grant team, is that it's now over 11%.
Hmm.
Uh, I mean, there are risks. There are risks that the tariffs are moving in the wrong direction. Another risk that people never talk about in terms of economic performance is the disastrous demographics.
Right.
We have we're going to have one of the slowest growths in population in U.S. history, if not record, probably very close to it. The birth rates are coming down all over the world. The world economy, the key economies of the world are becoming older. You want young economies. That's another risk. Um, Another thing that's happening that everyone is ignoring is that the major economies are shifting more and more into command and control.
Mhm.
And what command and control economies do is that they make economies more inefficient, less productive. And so we have these significant risks, but no one is concerned about them because prices are high for a lot of things, makes people good. They feel that if it's okay with the markets, it's okay with me. But I would recommend them to go back and read Kindleberger. Um, because I mean these kind of mania situations can go on for a long while. But the thing that Kindleberger demonstrates is that after the mania, you have panic and then you have crash.
Mhm.
No one can time them, Adam. No one can time them. But it seems to me that that's the model that people need to be looking at very, very closely.
Okay. Super helpful. Um, all right. So I asked about optimism. You were kind enough to say, "Hey, look, I just don't feel that optimistic, and here are the reasons why." I'm going to put an optimistic spin on this.
Okay.
You tell me if I'm grasping for straws here, but it's that um, while all that is true that Lacy has just mentioned, and things may play out the way that history predicts they should here, so that the financial markets, the economy, the average investor may have tougher times ahead of them. You as an individual who educates yourself and positions prudently in advance of what is likely to happen from here, you can potentially change your destiny here to not become collateral damage to a lot of these concerns that Lacy mentioned. So that's the positive spin I want to put on here, Lacy, which is that
Well,
some
Adam, you're doing
education
a
and some
great job of
proactivity.
trying to have these very difficult, complex issues explained. And the educational service that you provide is exceptional. And I want to applaud you, and I want to tell you
Hmm.
that I'm proud to be your guest again.
Well, thank you, Lacy. That's a huge honor, and I am very proud that you were a part of this movement, and even more proud to call you a friend. So
Well,
thank
we
you.
are good friends.
All right.
We
Well, let me wrap up here.
we're
And
such good friends. We've broken bread.
we have, and I'd love to do it again. And Lacy, at some point, there are some topics that you and I talk about. When we're off camera or hanging out or breaking bread, that I would love to have a conversation on camera with this audience at some point in time. And I don't think we're getting a chance to do it at the conference, but things like, you and I've talked about wealth inequality and the growing wealth gap, and I know that that's a very big concern of yours for just
Very
America's
definitely.
future
Well,
socially.
one of the problems of you see what here's I've talked about this in the past, but historically, um, from 1870 to 1970, we grew in real per capita terms 2.3% per annum. In the last 20 years, we've only grown 1.2% per annum.
Yeah,
That's
that's not going to do
40%
it.
lower. And it the government share is going up. We can see in great statisticians such as Hendrickson and Berg have shown that as we move into command and control, that the growth rate ticks down. It's only ticking down of 1/10 of 1% for every 1% increase in government. It's very imperceptible. But we've now lost 40% against trend. And unfortunately, whenever this happens, it exacerbates the income and wealth divides. It undermines your demographics. And so we have to understand that in actuality, for the last 20 years, the US economy has done very, very poorly. And we've left a lot of folks behind. And I don't think this is healthy.
So I'm right there with you, as you know, and I do think that topics like this are big topics that really deserve more time. So I'd love at some point to sit down with you and then just do a discussion around these things. Another one that comes to mind is on the demographic side is, and this could be a sensitive discussion, but I know that you could handle it very well. which is, okay, now that we've essentially closed the border and we are we're in the process of deporting some percentage of the illegal immigrants that have come here. It is, whether you support that or not, it is giving the opportunity to sort of say, okay, well, going forward, what should America's immigration policy be? And I don't want to put words in your mouth, Lacy, but demographically, it's very hard to see, if we want the economy to continue to grow anywhere near at rates that we had in the past, that we're going to be able to do that just with natural born citizens, at least at this point, with these low birth rates. So we're going to need immigrants, and immigrants have always been an important part of the American economic story. And I'd just love to hear your thoughts in greater detail than we have a chance to go into right now, that if you were given control of shaping policy going forward, what would be the key tenets?
No, we have to find a way to be able to um, to scrutinize applications, determine who coming here seeking economic opportunity, who is coming here to work with the system, expand the system, and not to destroy the system or lean on the system for support. Um, I'm reminded of Milton Friedman was such an economist. He was such a great economist. And he wrote on so many things, but one of the things that he said is that immigration has always worked to the United States advantage when people came here seeking economic opportunity.
Mm-hmm.
And we've got to find a way to do that in the concept, in the terms of the fact that we are a nation of laws, and we want to do this in accordance with the legal process. And it's going to be one of our highest priorities, and it's one of the ones that we need to be turning our attention to as soon as possible.
All right. Well, look, my friend, after the conference, after maybe the holidays, at some point in time, I'd love to roll up our sleeves together and dive into this, and maybe even do it in a live setting, so that the audience gets a chance to ask you some of those curveballs, let you take a swing at them yourself. But that's down the road. But folks, if you've had any interest in that, let us know in the comment section below. So in wrapping up here, Lacy, first off, thank you, and everyone, please thank Lacy.
Always a
Let him know how
pleasure,
much you
Adam.
appreciate him coming on by hitting the like button, then clicking the subscribe button below. Um, if you want to hear Professor Lacy Hunt go through his master class in what's happening in the macro world, and tackle those larger questions that I mentioned we're going to tackle in the conference, then please run, don't walk, to go sign up for the conference now. And you do that by going to thoughtfulmoney.com/conference. Right now, you'll get the lowest early bird price discount that we're offering, so do it quick. Get there quick and buy your ticket quick. And if you are a premium subscriber to our Substack, don't forget to look at your email. I've sent you a code that you can use to get an additional $50 off of that price. Last point, if you are, yeah,
Can I do a little advertisement here? No homo.
absolutely, go ahead.
Here's a great book. Can everybody read the title?
Hold it up just a little bit more. There you go. Kindleberger.
You see the title?
Yes, The World in Depression. This scares me, because I think you're going to tell me this is going to be really relevant for the next
Well,
decade.
it's why we need to understand that working we don't have the same system. Then we didn't have unemployment insurance, we didn't have Social Security, we didn't have bank insurance, so we wouldn't go to depression. But it's the process of what happens when you have an extended period of beggar thy neighbor policies. And it's a great book. It's a very learning process from a
All right,
great.
I'm making a note to myself right here to go literally buy that on Amazon the second I get through with you here, Lacy. I think a lot of other folks watching will do so too. So folks will read it all together. And from those of you that are feeling a little uneasy, perhaps, about your personal financial situation, if the future plays out the way that Lacy thinks it may, then highly recommend you consider benefiting from the guidance of a good professional financial advisor, but most importantly, one that takes into account all the macro issues that Lacy has teed up for us here, and have them help you, come up with a portfolio strategy and then execute that for you, that in a way that hopefully will help you avoid the worst of what might lie ahead, and maybe even position you to profit from some of what might happen. If you've got a good financial advisor who's doing that for you, great, don't mess with success. But if you don't, and you'd like an opinion from one who does, then consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. These are the advisors you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the very short form at thoughtfulmoney.com. As a reminder, these consultations are totally free. There's no commitment to work with these firms. It's just a free service they offer to be as helpful to as many people as they can be. Lacy, look, I just cannot thank you enough, my friend. It's a very important time to get the experience insights of longtime experts like yourself. Very much appreciate you coming on, sharing so much with us.
I'm glad to do it. You're such a friend, and you such a great professional, and I'm glad to be associated with you, Adam.
It's such an honor, my friend. All right, well, look forward to seeing you at the conference. But until then, have a wonderful Labor Day, Lacy, and everybody else. You too as well. And thanks so much for watching.
Silver is going to fail to deliver. In my eyes, that's within the next few delivery periods. So I think before year end, you're going to see the silver market break. That will immediately spill over to gold. Clearly, China has way, way more gold than they say they have. I think probably Russia too. And just go back to the old saying, he who has the gold makes the rules. And that's what they're preparing for. They're preparing for the dollar/bonds, treasury bonds to implode.
I mean, so much is going on under the radar here. And that's probably because a lot of, when you think about the gold that's flowing into China, gold and silver flowing into China, it goes through 42 customs districts, which have 680 individual customs offices. I mean, there's so much fiddle room here. It's unbelievable.
Given that failure to deliver is expected to occur during the next few delivery cycles, probably before year-end, the silver market appears to be on the verge of collapsing. The shock would swiftly leak into gold if that were to occur. As the USD and US Treasury bonds teeter on the verge of collapse, China and Russia are likely holding significantly more gold behind the scenes than they acknowledge. While central banks currently hold almost 36,000 tons of gold, making it the second largest reserve asset after the dollar, and, in some ways, surpassing the euro, China is relaxing gold trade regulations to facilitate physical movements. Gold has reached fresh highs due to geopolitical threats, record central bank purchases, and waning dollar outlooks, and a WGC survey indicates that the majority of central banks want to boost gold holdings while cutting dollar exposure. Bill Holter, a well-known precious metals analyst and commentator, with Andrew Maguire, a veteran precious metals trader, highlights that gold and silver are seen as the ultimate hedge because, unlike paper assets, they can't go bankrupt. Recent reports show gold and silver prices are rising due to heightened geopolitical tensions, weak dollar expectations, and inflation concerns. Silver has lagged gold somewhat, but many commentators believe the gap, gold-silver ratio, indicates silver is undervalued. Silver, in particular, looks to be breaking out as China tightens its grip on the physical market, leveraging that position to influence paper trading. For years, nations like Russia and China quietly accumulated metals to avoid direct confrontation, wary of U.S. military power that historically enforced dollar dominance, examples being Saddam Hussein and Gaddafi, both eliminated after pushing for gold-backed alternatives. Dalio warned the U.S. economy is showing signs of a financial heart attack, driven by rising debt costs, citing its history of rising in crises and protecting against currency devaluation. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Gold and silver, and the reason being gold nor silver can bankrupt. They are money themselves. They cannot bankrupt in a world that is bankrupting.
Absolutely. And I think if we can revert back to silver for a minute, because what we're seeing here is a huge, long-awaited breakout. And And I mean, obviously, we all know that China has been in the driver's seat for a long time, and they've been playing the arbitrage trade and, being in control of the physical side of the market. They could arbitrage the paper side. But essentially, what we're hearing is, hey, gloves are off now. And especially after Trump's most recent BRICS attack on the BRICS, like clearly putting the BRICS in the crosshairs with tariffs, and then most recently some very odd statements that he made after the SCO meeting.
Your comment, the gloves are off. I think that's up until this point. I mean, it would be extremely easy to break the Western financial system with $5 or $10 billion. I mean, if you went into COMEX and LBMA and said, "Here's $10 billion, I want metal," it'd be over. There's no way to deliver that kind of metal short term. So it would break the markets. In the past, I want to say that Russia, China, the rest of the world were being polite because they didn't want bombs raining down on them. One of the big things, the reason the dollar has been the reserve currency for so long is the U.S. military. Basically, we forced the world with threat of the U.S. military. If you don't use dollars, I mean, look at Saddam Hussein. Look at Gaddafi. They both talked about, 15, 20 years ago about doing a gold-backed currency. And what happened? They were killed. In the past, countries have seen, those two examples, Gaddafi and Saddam Hussein. They saw those examples and said, well, yeah, we'll just buy it quietly. And now that the war of words is on, it would not surprise me to see either a country or countries together step up. And the Achilles heel to the Western system is the fractional reserve nature of the entire system. But the way to expose that is just create a failure to deliver in either silver or gold, and it'll be both within 24 hours. If either goes, the other's going to go within virtually immediately. So they're at the point now, like you said, the gloves are off, and money is just flowing into, whether it be the physical metal itself or even the leveraged contracts in the West. You're seeing foreign nations buy those.
And I think most recently, and I know we're recording this on the 3rd of September, so it's not really a time-sensitive thing we're talking about here, but essentially what just happened, and I don't think this is clearly not going to change, is that it's quite clear from Trump's comments that the SCO meeting between these major hubs that you're talking about, and military powers as well, really ruffled the White House's feathers here. And they're not handling it very well, because basically, I guess really, I mean, maybe I'm naive to think, wouldn't it be better to have a multipolar world where you take all the barriers down? But I guess US dollar hegemony is the problem here, is it?
Well, that's the problem that the rest of the world sees. The rest of the world wants to get out from under Uncle Sam's boot, if you will, by using dollars. They don't want to use dollars, and they'd prefer not to be in the SWIFT system. I mean, ask Vladimir Putin. The U.S., the West, stole 300 billion plus of U.S. treasuries going back to, 2023, October 2023.
According to Bill Holter, cryptocurrency was created as a diversion from gold and silver, which are the real alternatives to the dollar. Since silver was designated a key mineral in the United States, its significance has increased, potentially limiting world supplies and retaining domestic production. Deficits are growing as Mexico's output declines and industrial demand for electronics, EVs, and solar rises. Silver may also be withheld by nations until prices significantly increase. By 2026, Analysts predict prices to reach between $40 and $52.50 per oz. However, since no fiat could purchase gold and silver in the event of a currency collapse, they might become invaluable. Let's shift our attention towards the interview.
But I believe that the crypto market was created as a pressure relief valve from gold and silver because they are viewed as an alternative, a dollar/currency alternative.
But silver's got my attention at the moment, and because you again, you and I always have talked about silver. You've been so far ahead of the curve on silver, and I think it's now being by the US now suddenly naming it as a critical mineral. To me, that would mean that they're caught in a rock and a hard place here, because that means that US mined silver, that they probably start banning the sale of it. It has to be bought internally, perhaps. I don't know. What's your thoughts? Because to me, why would you allow a critical mineral to be sold?
Right. Well, I mean, look at it this way. Naming it as a strategic mineral or strategic metal automatically creates the demand of whatever the government's going to buy. And it automatically reduces the supply available to the market because that supply is being bought up by the government. So you've already got a disastrous supply-demand equation. They just poured gasoline on that fire.
Yeah, and of course, what you essentially were saying here is that every other central bank, every other sovereign, everyone else is going to say, well, I'm not selling my silver at this price. I want a much higher price, and I don't quite know what that is yet.
The much higher price, I made the comment before we started recording, be careful what you wish for.
Yes, yes.
When we go through $50, that's if markets stay open. I mean, there could be a failure to deliver, this month. I mean, who knows? But once we get through $50, you've got people talking $100, $200, $600 silver. There's really, in today's world, there is no way to project a number that gold or silver can go to. And I mean, the reason being, the parameters are zero and infinity. And the reason infinity is a parameter is because if a currency goes to zero, then it is priced at infinity in that currency. In other words, no amount of currency can buy an ounce of gold. That currency won't be accepted. And that's where we're headed on a global basis. I mean, if you think that the US dollar can collapse, crack up, and the system remain running, that's not going to happen. It can't happen.
Could the long-awaited decoupling of paper and physical prices be triggered by a real failure to supply silver on COMEX? How long before gold officially threatens the dollar's position as the primary reserve asset if central banks continue to reduce their exposure to the dollar? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
At the end of this, it's going to be a silver standard, not necessarily a gold standard. Going back to gold would be better where we are now. But the real end of the inflationary system is when credit is going to collapse. When credit collapses, dollars don't work. And if dollars don't work, none of the other currencies work either, because that's what we say reserve currency, right? That's currency that's in the basement of all these other central banks. So when the dollar falls, or these other currency falls, all credit falls, all credit derivatives, and then you're left with all the purchasing power of all that lost purchasing power gets vacuumed into silver, even more than gold, which is why we're going to go eventually to very near a 15-to-1 ratio, which is the historic exchange ratio, monetary exchange ratio between gold and silver. That's natural economic law.
Analysts note that in a crisis, gold and silver could surge, with the gold to silver ratio potentially falling from 90-95 to 1 back toward its historic 15 to 1. Silver's dual monetary and industrial uses, combined with its affordability, may spark strong demand from ordinary people. While fiat collapse isn't directly emphasized, stress from dollar weakness and debt issues could still drive a rush into physical silver. Rafi Farber, also known as the endgame investor, is a financial writer and precious metals analyst. Silver played a central role in global trade for centuries, particularly in China, where taxes were often paid in silver, thereby tying the economy to the metal. This dominance shifted after the U.S. Coinage Act of 1873, known as the Crime of 73, which demonetized silver, hurting miners, farmers, and debtors while favoring the wealthy who held gold. Attempts to restore silver through the Bland Allison Act, 1878, and Sherman's Silver Purchase Act, 1890, were short-lived, and the system remained gold-centric. Recent scholarship also highlights how silver's volatility, particularly in Ming China, fueled both trade growth and inequality, concentrating wealth among elites at the expense of ordinary people. Rafi argues that societies built on financial theft eventually face a reckoning, just as debts must eventually be settled. In the endgame, silver will likely return to a stable 15 to 1 ratio with gold, forming the base for rebuilding a more honest economic system. Gold and silver are regaining importance in global trade as nations transition toward a hybrid system that blends traditional money with digital tools. Despite slower global growth, metals are forecast to rise over 30%, driven by fiscal pressures and safe haven demand. Analysts also suggest silver could outperform gold due to the historically high gold-to-silver ratio. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
A lot of people say, and I think they're correct, that we've been talking about the pyramid, right? And gold is at the bottom. But underneath the gold is an even smaller triangle of silver in terms of value. Look, before gold was money, we talk about gold standard and going back to gold standard, and this is what we have to do. But really, it's not exactly that. It's really going back to silver is what we need to do, or what will be done. I understand that, trading silver coins is not economical in the sense that it's very bulky, and you can't actually exactly do that in today's world. But the human civilization started not on gold, but when we really started global trade and continents started trading, and the Silk Road, and Africa started trading with Asia, and you really got a big economic system going, was based on silver. And what happened in 1873, right, with the crime against silver, or what exactly they call it? I think it was the crime against silver. What happened was, who owned silver back then? It was the poor and the middle class. That's what they used for their money. What did rich people do? How did they store their wealth? They stored it in gold because they had too much silver. They couldn't store it all. And so they had a lot of gold. So what's the best way, if the middle class and the poor, and there's a lot more middle class and poor than there are rich, what's the best way to take purchasing power from the middle class and the poor and give it to the rich? If you're on a silver standard, move to a gold standard, right? That's how you do it. But everything that the government does in order to keep the pyramid going is basically a theft of the middle class and the poor, for the favor of the rich. We have to go through a reckoning. That's natural law. Like, just as all debts are paid either by paying the debt or defaulting, all theft is paid too. Because when you steal, that value, when you make an exchange of two people and they're both benefiting, legitimate, when you steal, one loses at the expense of the other. And so you have a net negative effect on society. So when you have a society that operates through these sorts of theft systems, those thefts and those debts are going to be paid one way or another. Now, I have no dollar figure for where silver is going to go in the end game, but I do believe strongly that the end game bell. How do we know when this is all over? Like, the bell's ringing. Okay, well, the dollar has collapsed. It's going to be at a 15 to 1 gold to silver ratio, one that's relatively stable. I'm not saying like we hit it one day, like in 1980 it happened for a day and a half or something. I'm saying this time it's going to stay that way until we can rebuild a basic economic system again. So it could be a year or two, three. I don't know, but I'm saying it's going to be stable enough that silver supplies can filter through the economic system, physical silver supplies, and that figuratively almost literally creates a base of wider silver dispersal where you can rebuild another credit pyramid, hopefully an honest one where all debts are paid and you don't have fractional reserve or however you think the bank system functions. Well, what does the United States look like? I really don't know, which is why, frankly, I don't want to live here. I don't know what Israel's going to look like either. I'd rather be with my people than being here, precisely because I don't know. I would imagine that states could break off from the federal government. The federal government could dissipate, and you could have regions, different regions. Like if the South had won the Civil War, you'd have the Confederate States and the Northern United States. So, might break into a few pieces. I think there's going to be serious trouble in the very big cities like in LA, New York, Chicago, Minneapolis, where you're from. These places that are morally rotting. They're not going to do very well. But I think outside of that, you will have Americans, and America will exist. The United States as it exists now, I don't know. I can't say yes. I can't say no. It might reorganize into some looser government or Articles of Confederation or something. Or California, New York could cede and then leave the more fiscally responsible states into some other union. It could be anything. I just hope that we get through it with the minimal amount of suffering.
Rafi relates that the rise in prices we see today is only an illusion created by the inflationary system. When measured in real money, gold and silver prices have actually been falling for decades. If someone consistently saved part of their income in gold or silver, over time, they would need less of it to maintain or even improve their standard of living. The point isn't to stack metals to cash them out for more dollars later, but to step outside the illusion of the dollar system as much as possible. These metal-focused trends reinforce the notion that the current system creates an illusion of rising prices when measured in dollars. At the same time, real value units, such as silver, offer an accurate preservation of purchasing power. Rafi points out that the de-dollarization movement and individuals turning to gold and silver echo your point about trying to live beyond the constraints of the fiat system. Analysts predicting outsized gains in silver align with the idea that steady savings in metals could result in maintaining or improving one's standard of living over time, even as the dollar erodes. Now, let's recall the interview.
It's not that prices are rising. They only seem to rise within the inflationary system, within this illusory system that we're all stuck in, like a prisoner's dilemma, and we're all stuck in it. Prices are actually, they've been going down since 1960s. I mean, if you look at everything priced in money
And gold.
Money, I mean gold and silver, mostly gold, silver secondarily. But if you look at actual prices, they're going down. And so the prices are only going up if you insist on maintaining your economic existence within the illusion itself. And you could say, okay, fine. So let's say I want to get out of the illusion and just, take all of my salary and just buy gold with it every month. Well, I understand you can't do that because you need to be liquid, and gold is not as liquid as dollars. It would be if we were on a gold standard, but it's not. So then you could say, so then, we are losing out. But it's not just that prices have been staying stable in gold. They've been falling in almost every category. And anything priced in gold is going down. So even if your dollar salary is less, right, then the amount of gold would keep going down with however much you could put away every month. Let's say you earn like $5,000 a month, and you put, $1,000 a month away or $500 a month away in gold and silver over 20 years, and each month it's less and less gold and silver because they keep going up. But you need less and less gold and silver to even have higher standards of living. So you can live outside of this illusion. That's what I'm trying to get people to understand. It's not about stacking and then becoming rich and then using gold and silver to accumulate dollars. We're getting out of the illusion as much as we can. It's like like a drug addict, right? If you're talking to a drug addict, you have to understand how they think, you can't go completely into their world, but you care for them, so you need to communicate with them in a way that they think that you're on their planet. But you have to. It's a very difficult position where we are, because we have to put a leg in the illusion, and we have to keep a leg out of it and keep our minds together, which is it's very difficult even for people like us. It's all the more difficult for people who don't understand intuitively with the confidence that gold is actually money, and it still is today. That was the final piece that fell into place for me. That only I think like in 2022 or something like that, when I finally understood, when it finally slipped into place that everything is really based on gold and silver in this entire pyramid that we're living on. The higher we get on it, the thinner the air gets, and the more insane we become keeping one leg in it while trying to keep one leg out. But
Rafi Farber's insights highlight silver's historic and future role as a form of real money, capable of preserving purchasing power and providing stability when fiat systems fail. With de-dollarization underway and precious metals gaining ground in trade and investment, silver's potential resurgence to its natural balance with gold reflects both a historical truth and a practical strategy for navigating today's uncertain financial landscape. If silver does return to a 15-to-1 ratio with gold, what impact would that have on global wealth distribution? How can individuals today best position themselves to step outside the illusion of the fiat system while still meeting everyday liquidity needs? We'd love to hear your thoughts, so feel free to share them in the comments section below. If you enjoyed this content, don't forget to hit the like button and subscribe to stay updated with future posts. Thanks for being part of the journey.
The point is, we're seeing lots of silver that is being accumulated by the central banks. That's $2,225,790,000 worth of silver has come into COMEX. In the first week or so of the month, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. Most of the public has zero idea that there is a massive drive going on for gold and for silver. First week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend.
Central banks are quietly stockpiling huge amounts of silver, with Russia, China, Saudi Arabia, and India leading the charge. Saudi Arabia has made small but notable purchases of silver via ETFs recently, which may signal a shift in behavior. China has bought 21 metric tons of gold so far this year, 2025. It's part of their strategy to diversify away from the dollar and align reserve assets with their global status. The notion that BRICS and other developing nations are considering silver more seriously due to its dual uses is being more widely reported. India alone has accumulated 600 to 800 million ounces in the last 5 years, more than what COMEX and LBMA hold combined. The US, traditionally an importer of silver but never of gold, is now importing both, a clear sign of a much larger global trend toward physical accumulation of precious metals. Andy, the president and CEO of Miles Franklin Precious Metals, highlights that what makes today's market different is the sheer scale of physical gold and silver being accumulated, not just by investors but by central banks, with Russia allocating it in its 2025 to 2027 budget and Saudi Arabia making ETF purchases. COMEX deliveries of gold and silver remain historically high, signaling strong demand for physical metal, while a weaker US dollar is further boosting gold and drawing silver into reserve diversification strategies. Analysts like Mike Maloney see silver poised for significant upside in a potential monetary reset, though claims of India's massive silver accumulation and extreme delivery spikes remain unverified. Experts also warn that paper metals may not provide true protection in a crisis, driving the push toward physical holdings. Andy believes the public, meanwhile, remains largely unaware of this massive shift toward physical metals. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, I think that what differentiates this market from anything I've ever seen, Ivan, and I've been doing this now for almost 36 years, is the amount of physical demand that is being accumulated. Now, we've talked at length about the central banks that have been buying gold. We're seeing action with the central banks buying silver. Now, of course, it started with Russia saying they were going to add it to their stockpile. First time I've ever seen a government do that. And then it mitigated moved towards China. Talking to guys like Sean Kuhn from Dolly Varden, he says, look, Andy, the Chinese, who are the second largest producer in the world, they told David Morgan they're the first, by the way, but needless to say, they're massive producers. Sean says they're flying all around Latin America, in particular places like Peru, even all the way up to Mexico, and pulling metal out of the ground before it's even called silver. They're buying doré, they're buying concentrate. They're paying double what the West will do to disintermediate the whole market, sending it back to China for refining. So you have the first or second largest producer in the world finds it significant enough to fly around the world and buy doré and concentrate right out of the ground from the miners, directly from the miners, and then sending it back to do so under the cover of anonymity, so to speak. No one really knows how much they're buying or what they're getting, but Sean can validate that is indeed what is happening. You look at the Central Bank of Saudi Arabia. Disappointing as it may be that they bought huge amounts of SLV, maybe one of the worst products I've ever seen ever in my career, because just as a side note, the short position right now in SLV is 53.97 million shares,
Wow.
which is it's grotesque, it's ridiculous. And remember what the prospectus said, BlackRock said, there could come a time when there's not enough silver to cover those short positions, buyer beware. But the point is, we're seeing lots of silver that is being accumulated by the central banks. What is really different to me, as far as I'm concerned, is the amount of silver that is coming into the COMEX. And, last week I jotted down some numbers. In month to date in September, the number of contracts, and this was last week, I'm sure it's much more now, that stood for delivery was 10,599 contracts. Let's do the math real quick. 10,599 contracts times each contract weight being 5,000 ounces is 52,995,000 ounces. We'll multiply that, let's just call it by 42. That's $2,225,790,000 worth of silver has come into COMEX in the first week or so of the month. And this is what we've seen over and over and over again. The point I want to get across here is that when you have countries, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. And now you see it happening in the United States. At this level, the people don't just have the most money that are standing for delivery. Now, when we say stand for delivery, mind you, this is going into COMEX. A lot of it leaves. A lot of it doesn't leave. So regardless if it's leaving COMEX or being put into an eligible account, not registered, meaning it's not available for sale, it's going into strong hands. To this degree, these people are not only the most well-funded traders on the planet, i.e. the central banks, the commercial banks, the very sophisticated traders that can stand for delivery on COMEX to the tune of billions of dollars every month since November, since the election, but they're also the most well-informed. And I think that's the most important thing to understand, is that the people at this level who swim in circles of 9-figure monthly acquisitions are not doing things just for kicks. They're doing it because they understand where we are going. They know the playbook. They are at the highest level of information. And that's what I take away from really where we're at this moment, is that price is relevant, but price is a tool of misdirection. allowing the big money to position before all of the people that you and I call friends outside of what we do for a living talking about this stuff. The people who may be very smart, very bright, very well read, arguably just reading the wrong shit. And that's the problem. So most of the public has zero idea that there is a massive drive going on for gold and for silver in terms of delivery. Just as a side note, in the first 5 days or so, 6 days of the September contract, which is a non-delivery month, 3,626 gold contracts and 100 ounces apiece stood for delivery. So you're talking $1.5 billion there too.
Wow.
So in just the first week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend, and that is that the smartest money in the world understands that there is a rush for physical acquisition of metal, bypassing the paper promises. So there you go. Crazy times, brother, and I think we're just beginning in silver.
Andy points out that central banks and BRICS sovereigns Russia, China, India, and Saudi Arabia are accelerating gold and silver accumulation, often buying ore and concentrates directly from miners, while the West relies more on paper vehicles like SLV. Russia confirmed BRICS talks on a new precious metals exchange with its own pricing, clearing, and auditing, reducing reliance on the Western system, while silver is gaining traction as a reserve asset, with reports of Russian buying and Saudi Arabia making first ETF-linked silver purchases. Analysts warn Western price suppression looks increasingly like misdirection, with BRICS building parallel commodity infrastructure to secure physical supply. Experts predict gold will remain strong, and silver could see outsized upside given its smaller market, though volatility and delivery bottlenecks may increase.
The only saving grace is, and maybe I would like to think they're not misinformed. See, if you and I bought SLV, we can never take possession. They can, because it's the amount that they purchased. You have to have a certain amount, and it's called a basket. If you are able to redeem a basket, which I don't know the exact amount, 20, 30, 40, $50 million worth, they can. So I'll give you an example. Kyle Bass, when he was running the fund for the Texas Teachers Union years ago, they bought, if I'm not mistaken, $1 billion worth of GLD. They stood for delivery. Saudi Arabia can do the same thing here. They do have the right to stand for delivery, and most of that metal, if I'm not mistaken, is held in the LBMA. So because they bought such a significant amount, they can stand for delivery. And maybe they had a reason behind doing that I'm not sure. For you and I, buying SLV is as dumb as a mud wall. Not only do you pay the capital gains for collectibles when you sell it, you can never take possession. It's custodied by JP Morgan and BlackRock. Of course, JP Morgan, as we have identified multiple times, paid the largest fine that the Justice Department had ever handed out at that point, $920 million or so, for manipulating the silver market. Well, and that was kind of, and the reason that I think that they got off so easily, I believe that this was done at the behest of the central bank, who gave them the green light to do this. And there are bigger reasons at play for holding down the monetary metals, but that's for another discussion. Simply to say, it was far more. In fact, you could argue that it was far, far, far more than just spooking. It was manipulation, and it was at one point thought it would be RICO charges, because in essence it's like the hitman kills someone, well, they can go after the mob boss because the mob boss ordered it. Well, the point of it is that who up the chain of JP Morgan understood this? Is it just the head trader, Michael Nowak, who was the sacrificial lamb that was put in jail for a couple of years? Or, I don't know. The point of it is that this is something that you can only manipulate a market, Ivan, for an extended period of time by pushing it in the direction that it is going. And I've been doing this for almost 36 years. Most of the time, the world didn't want gold and silver. They wanted U.S. bonds and U.S. stocks and real estate. They wanted what was, when things got scary, there was a rush to the dollar. what is happening now is that the big money around the world has become motivated, coordinated, and sophisticated, and they understand what's happening. The big money around the world largely being, when I say that, I'm talking the BRICS countries, in particular Russia, China, now Saudi Arabia, India. All of these countries understand, and they have been using the spoofing or the manipulation or the suppression of the metals market against us. In other words, hold the paper price down in the West and then go all around the world and drain the supplies, especially off of exchanges around the globe that don't affect the price. The price is set in the West, so if you smash the price down on paper here and then buy it up there, and there, boy, that works out well. And they're smart enough to see the big picture. That's what they're doing. And then they go as far, and just ask yourself, the second largest producer of silver in the world, the largest producer of gold, don't sell an ounce. They fly all over the world and buy gold and silver in doré, which is a crudely refined bar, in concentrate, which is a byproduct of it, right from the miners, which completely disintermediates the amount and disintermediates the market and the commercial banks. They're thinking 2 or 3 steps ahead. They're playing 3D chess, we're playing checkers. So I think that this is something that is being used against us without saying so. They get it. I'll evidence it this way. You know, I've spent a lot of time talking about the BRICS, and the BRICS grain exchange is something that is under development. And I listened to an interview about the guy who's running it a year ago, and he said, you know, we here in the BRICS produce and consume in the global south more wheat than they do in the West. Yet we have no control over its price because that is controlled on COMEX. But with the development of the BRICS grain exchange, that will change. Now,
Wow.
You know, they understand what we're doing with the precious metals, with the base metals. All of the things that we have suppressed for various reasons are now being used against us. It's jiu-jitsu. The premise being you use your opponent's leverage against them. And this is exactly what's happening right now, man.
Will central banks' increasing use of silver lead to a structural revaluation to that of gold? What potential effects may the establishment of a BRICS precious metals exchange have on shifting global pricing power and diminishing the importance of Western markets? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.